Welcome back, everybody. As you know, a while back, I wanted to put my cash to use while I was doing options, and I decided to make a dividend portfolio using some income funds. Turns out this is called the quadfecta portfolio, and that's when you use QYLD, Nusi, JEPI, and DIVO to create a portfolio that would generate income on a monthly basis. And when I set up this portfolio, I wanted some downside protection, so I decided to go a little bit heavier in Nusi. And looking at the performance now, I'm looking at it now, and I had to go, what the heck is going on? So in this video, we're going to be looking at QYLD and Nusi, compare those two, see what's going on with Nusi, why is it underperforming a covered call ETF that doesn't have downside protection when the market is going down, and tell you what I'm going to be doing after the fact. So this is actually a snapshot of my portfolio. And you can see that I'm actually pretty heavy in Nusi because I wanted that downside protection. But it's actually the worst performing position in my portfolio by a pretty decent margin, actually. So Nusi, I'm down 12%. QYLD, I'm down 10%. JEPI and DIVO have been holding up pretty well in this market, which I was really surprised about, truth be told. So what I wanted to do is I wanted to look at my worst performing position and see if I still wanted my portfolio. Now, something that just blew my mind was the fact that QYLD and Nusi both sell covered calls on the NASDAQ 100, and QYLD has no downside protection, but Nusi does. Yet, QYLD is outperforming Nusi? Why? And that's what we're going to be looking at. So, QYLD, they sell at-the-money covered calls on a monthly basis, which is going to generate about 3% premium. I think this actually is 2.7%, but we're going to say it's 3% just for easy numbers here. And then what they do with that 3%, they pay out 1% as a dividend to the shareholders. So that's the income that I get every month. And then 2% is rolled back into the fund to buy more positions. So some of this money is getting reinvested with QYLD, meaning they're buying the dip as it's happening, and they're averaging up when it's going up. Now, Nusi, on the other hand, they sell out of the money covered calls. Now, what this means is if the stocks move up, they still capture that capital appreciation, but for selling further out of the money calls, they receive less premium. In this example, they only get about 1%, maybe a little bit less, when they sell this on a monthly cycle. And then what do they do with that 1% that they get? Well, 0.4% of that goes into buying puts for that downside protection, and then 0.6% is paid out as a dividend. So you get a lower yield. They take that premium that they received and they buy out of the money puts, and that's where they get that protection from. So only 0.6% of that 1% is actually paid out as a dividend. 0.4% goes to buying puts. Now, what do we know about puts that are out of the money? Well, they expire. So we know that when you buy an out of the money put, if it doesn't go in the money, it's going to expire worthless. So anything that you put into that is completely worthless unless you move in the money. Now, these puts that Nusi is buying, if they only spend 40% of the premium received to buy the puts, they're buying pretty far out of the money. In this example, NXD would have to move down to 11,864 in order for it to become in the money to start being worth something at expiration. Right now, it's trading at 1,400. That means it requires a 16% move in the downside for these puts to actually pay off. It would have to do that in a month. If it takes longer than a month to move 16% or more, then the puts would have expired worthless, and Nusi would have bought the next month's cycles already. Something else to just think about is even if the market decides to go down, say 10%, and these puts are worth more money on the pink line here, Nusi's not going to sell those to lock in that gain. They're holding this sucker till expiration. So you need that full 16% or more movement for those puts to have value, because otherwise theta's going to come in, eat up that value over time, and that's why that put protection should normally just be worthless, essentially. Looking at some price points for this year, from January 1st to February 1st, the NDX only dropped about 8%. The first month, second month, if you say that 26 was the last day, it's only dropped 6%. And remember, we need about a 16% move for that put protection to be worth it. So all those puts have not really come into play because they just expire worthless eventually. Now, sure, it might have added some stability to the price of Nusi, so that didn't drop as much because those puts would have gained value. But as time went on, those puts did lose their value over time anyway, so it evens out. It just looks a little less volatile during the month, but honestly, I don't care what it looks like as long as it's paying me an income. I don't care if the stock is moving up or down as much, kind of like what QYLD kind of did. So that kind of brings me to what am I going to do? And for me, I think I overvalued the downside protection that Nusi gave. It's not really downside protection at all, it's crash protection. And if you think about how frequently that actually happens, once out of 8 years, well, we just had one like 2 years ago. So the chances of the puts paying off are slim to none, it feels like. So why am I giving up all that extra income for that downside protection that is probably not going to pay out? Because remember, even though Nusi only gets 1%, which is less than QYLD to begin with, it takes a portion of that, or almost half of it, and uses it to buy these puts that mostly expire worthless. And I just don't see why I'm paying for that protection if I don't think it's going to be kicking in. So for me, I'm looking to at least trim my position, because right now I'm heavily weighted in Nusi, and that's because I overvalued the downside protection. And I might even just cut it out completely. So for me, the Nusi dividend date is actually here. The X date was the 25th, which means I'm going to be getting a dividend, and that dividend should be paid on the 28th. Now, I have dividend reinvestment turned on in my portfolio, so even if I sold the shares now, I'll still get that dividend, and I risk the chance of Interactive Brokers buying me more shares, even if I sell my position, which would cancel out the tax loss harvesting that you can do for selling those shares for a loss. What I mean by that is, if I was to sell my entire position here, I have a loss of about $10,000. If I gain $10,000 from all my other trades, and that's all I did for the year, these losses would offset those, and I'd owe no taxes. But if I only gained $10,000 and everything else, and I sold these and bought more shares as the result of a dividend, I don't get to claim this loss here, and then I would owe about $2,500 in taxes off my other gains. So be careful about those loss wash rules. And so what I might do is I might wait until I see the dividend reinvestment happen in Interactive Brokers, and then sell my position and move on to the other funds. I don't think holding Nusi for an extra week in the long term is going to mean much to my portfolio, so I'm fine with holding it for another week. In fact, if the market continues going up, Nusi should follow that, because the cover calls by now are pretty far out of the money, so it should be based on the value of the assets of the portfolio anyway. So I'm not too worried about how fast I move out of Nusi, and you might see me by the end of the week be completely out. Now, what I'm going to be doing with that money that I'm taking from Nusi, which is about $75,000, I'm still deciding how exactly I want to disperse those funds, but they'll probably end up in some combination of being put into QYLD, DIVO, JEPI, and CH and SCHD, which is a new position I'm looking at, and I'm really liking what I'm seeing, so I might have to make a video about that. So I hope with this you understand more about what that put protection that Nusi has is about. It's more about crash protection, not downside protection. So in a downtrending market, it's not going to do well. In fact, it's going to underperform a lot more, because that protection is not kicking in, and it's collecting less premium from selling the cover calls than another fund like QYLD, because QYLD sells at the money calls, they collect a bigger premium. So that's why you see Nusi is underperforming QYLD right now. Now, if the market was to be crashing like 20% in a month, then it'd be a different story, and Nusi might be down less than QYLD. But I don't think that happens enough to warrant just being as deep in Nusi as I am, so that's why I'm going to be selling it most likely.